What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, what the logic is going to be here is kind of breaking down this idea of how we can look at valuing a stock. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and turn on those bell notifications for all future uploads. Now, as you will look at this video here, there's a lot of information, and I mean a lot of it. So watch it back a couple times if you need to, pause it, replay it, whatever it is you need, because there's a lot of things here. Because people have asked me on social media, how do you value this stock? How do you value this one? Where do you get your values from, your calculations? I'm going to show you what I do with this and how it works, and which ones could be potential buys based off of this data. So we're looking at two different models here in today's video. The first one is what's called intrinsic value, which is focusing on a couple things. It's focusing on the PE ratio, the earnings per share, and also what is expected of the company over the next 3 to 5 years. All right. Now, I plug in a lot of data here into these values here to kind of say, oh, okay, well, take a look at Adobe, for example. You know, Adobe's got a really good debt to equity ratio, very, very low debt. The return on equity is very good. Their margins are pretty good here. It's like, okay, well, it's looking like a good company, but what is the valuation right now? What can I pay for it? What should it be worth and everything? And what it comes into play is this last column right over here, these last couple columns here. These last couple columns focus on their intrinsic value 1 year, 3 years, and 5 years out. Okay. And again, this is the formula as to where I get these values from. You take your earnings per share, multiply it by what's expected of their growth over the next couple of years, and also multiply it by their PE ratio. Okay. So that's kind of what we're looking at in terms of the intrinsic value, and it's looking at how they're going to continue to grow. Now, again, I made some notes here. Obviously, the price is above it. If this price is above it, then it's going to be discounted. And what you will notice also with the formula up top here, hopefully you can see it in the top left corner here, is that what I have done is I've taken a safety precaution for it, right? The reason why safeties are important, especially in the finance industry and any kind of investments or money related things, is that if you are estimating growth potential, cash flow, you're predicting or estimating things, there obviously is bound to be a mistake. Okay. It's not guaranteed that it's going to grow that much there. So what do? Well, you give yourself a little bit of extra safety, a safety net. I know Warren Buffett's very known for doing this kind of thing. So I basically am taking only 80% of what these values come out to be, because that allows me to give me that safety net that we're looking at for the potential returns. Okay. So if you look on and again, the good thing is with technology is that Seeking Alpha, for example, breaks down, hey, earnings per share, their forward long-term growth of their earnings over the next 3 to 5 years. They're looking at a compound annualized growth rate of about 14.86%. So what I did is down the spreadsheet here, I plugged it in as a decimal and a percent, and that's just how the calculations work for me. 0.1486, 14.86, and it puts out these values here. And again, these values are with 80% taken off for all these. Boom, 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 right? So as you will see right now, Adobe potential upside to be about 10, by being down about 8%. 3 years up 21, 5 years up about almost 60%. And so saying, well, okay, Fridge, what do I do with this information? So the intrinsic values in this aspect, in this approach, is based on their earnings per share growth continuing, and that they keep producing more and more, keep growing how much they're earning as a company, right? Nothing to do with cash or anything like that, but based on their earnings per share and their PE ratios, which are valuations as to how the company's performing, right? And again, we take off 20% for a safety net in this case. So let's all take a look at this next section here, right? Intrinsic value for 1 year is 349.88. So I come over my spreadsheet here, and this spreadsheet is taking me a lot of time to do here. I'm plugging 349.88. Again, down about 8% upside for the year. So right now it's trading at about 381. So right now it's overvalued by about 8% in the 1 year. 3 years looking at 461.59. So plug that number in there. And then the 5 year was 608.97. So this is what we're looking at right now in terms of the 1 year versus the 3 year versus the 5 year. Now, what you will see is I annualized these returns in each of these columns here, right? So I've taken what the percent is, 21%, and divided it by 3 for it to be annualized for a return. Because again, that's the upside in 3 years. It's going to be up 21% in 3 years. Okay, but Annualized, it's only about 7%. It's going to be up 60% in 5 years. Okay, annualized is about 12%, right? And the reason why I did this is because, again, remembering S&P, the stock market index, S&P 500, only returns about 10% annualized per year. So if these numbers are lower than that, then what's the point of buying the stock and not just the ETF, right? What's the point? You want to make sure you're getting that good return that if you want to buy individual stocks and you want to try to outpace the S&P 500, you want to have it be bigger than 10% annualized per year. But now what you're saying is, okay, well, Fridge, what happens to this number? What if Adobe comes down to like 340? Okay, still a little bit of upside for the 1 year. And now we're beating the S&P on the 3 year and the 5 year. Okay, that's pretty good. So what this does, it allows you to determine, okay, where's Adobe going to go in the next 3 years, 5 years? And is it going to outpace the S&P 500 based on their earnings, based on their expected growth margin, right? And we don't know, obviously. So that extra 20% that I take off is just to factor in a leadway for it. Maybe we don't need to take off a 20%. We just let it ride out. But for me, I think 20% is going to be a nice low margin of safety here. So I'm looking at companies that have those green boxes, because those green boxes mean you are outpacing the S&P 500 every year, every annualized return. All right. So that's the one way of looking at it. And again, it's your intrinsic value based on earnings per share with the growth rate and their PE ratio. The other way of doing it is called a discounted cash flow. Now, what this basically does is says, okay, if they keep producing cash and you estimate how much cash they're producing in the future, what would be a fair value for the company now? So that way you're actually making money in this case. Now, thankfully, ChatGPT does a thing for us these days where you can ask for a discounted cash flow analysis of Adobe based on their past growth for the next 10 years. And again, what I do in this case, I ask for the bear case, which is like, what's the worst case we could possibly have? What's the base case? And what's the bull case where the markets rally, right? And so it breaks down, their compound annual growth rates. It breaks down their margins, their terminal growth value. It breaks down all these different things here. And it gives you a nice little summary here saying, hey, the bear case is about $290 here. So I put in about $290 for Adobe. The base case they come in with is about $500. And the bull case, they said, is $937, which is crazy. Good return, $937 about. Now, what you'll see here is, again, Fridge Financials does not, again, ChatGPT, AI, early stages of the market right now in the development of the future here. It obviously can make mistakes. We've learned that so far. So I'm taking off about 10% here as a margin of error, as a safety net, right? So basically taking this price here, take off 10%. Take this price, take off 10%. This price, take off 10%. And that's where these values come into play here. Oop, get rid of that. That's where this value, and this value are now coming in at with a discounted 10% taken off. Now, what does that mean? Okay, well, this tells me that the worst base case, the bear case scenario, Adobe is overvalued by about 24%. Worst case scenario. Base case scenario, it's undervalued by about 18%. And bull case scenario, undervalued by about 121%. So that's what it's looking at here. Now, with looking at these two models here, right? We're looking at intrinsic value based on their growth and intrinsic value based on their cash flow. These two different models I'm kind of using to kind of give me a good indication of it. And what I'm looking for is these green boxes, these green returns is what we're looking for here. Okay. We're looking for the green. That's what matters. So take a look at what I'm doing here at the end. I'm looking at the intrinsic values, how many of them were green from the intrinsic model approach, which in this case, if we take a look over here, I did block, for example. I did an option on block a little recently. Block was green for the 1 year, so super undervalued, even undervalued annualized for the 3 year and for the 5 year here. So block to me is looking at very, very undervalued right now. On the intrinsic side approach with their growth models, with their forecasts, and even with 20% taken off, still undervalued. With doing a discounted cash flow model based off of obviously using AI and using a 10% margin of error here, 10% safety here, also undervalued by 22%, 98%, and 109%. And these two columns here are counting up the boxes. So we're counting up 3 all undervalued for intrinsic, 3 all undervalued for discounted cash flow. Oh, baby, we got 6 we got all signs pointing to green. So block could be a good investment to take a look at for me personally. Another one I did it for was super microcomputers, which obviously also has hit greens and all three. Let's take a look, right? Again, current price, intrinsic 1 year with 20% taken off, with 20% taken off in the 3 year, within the 5 year, and you're still beating S&P 500's about 10%. That one's like borderline 10%, but 36% for 3 years annualized, 58% annualized. Intrinsic models are killing it just barely for the greens here. All right. And then we're looking at bear case, bull case, or bear case, base case, bull case with 10% taken off here of discounted cash flow. And we're still hitting greens here as well. So 3 greens for intrinsic, 3 greens for discounted cash flow. We're looking at all 6 pointing to undervalued. Now, are we always going to get all 6? No. And the way I had it set up was that even, I think it's like 4 to 6 is good enough for me. If we hit 4 percentages out of the 6 that are considered to be undervalued, I'm good with that. 2 to 4 or 2 to, let me see that. I mean, you know what? Let me just actually just do it this way. Format, conditional formatting. So if I have less than 2, it's nothing. 2 to 3 is like, okay, it's getting there. And then 4 or higher. So greater than 3, 4, or 5, or 6 is where we're looking at for those ones. So that's what I'm looking at. So in all my list here, and all these stocks I've done, Hood, Toll Brothers, Supermicro, Uber, Nvidia, AppLovin, Google, PayPal, Palo Alto, Adobe. I haven't done Microsoft. I haven't done Pinterest yet. I'm going to do those off of this video, obviously. Actually, we can just do these now. Why not? You know what? You guys get a longer video today. Why not? Let's hit up good old Microsoft here. So watch. This is gonna be Fridge Financials doing this in real time, and I'm gonna take away all these because these don't matter to me right now. All I care about is their expected earning or their expected growth. Let me get rid of all these. Clear it out. Microsoft. PE ratio, beta, all those things come into play here. Let's take a look. Go on to Seeking Alpha. Let's go to Microsoft. Microsoft growth, we're looking at a earnings per share long-term growth CAGR of about 12.17%. So 0.1217, 12.17, boom, boom, boom. Let's see where we're coming in at right now. Undervalued. Well, this one's overvalued. So let's plug the numbers in, right? So we got 390.62. 390.62. We've got 491.49. And we've got 618.39. 618.39. And again, as you'll see right now, Microsoft, with how they're looking, in the intrinsic value, overvalued by 10%, undervalued by about 4% per year you're going to get, which is less than S&P, and then 8% again, a little bit under than that. Okay, so now let's take this value. Now let's take, let me get this feedback on this one first for this response. Then we're going to take this prompt here. Copy this prompt. And we're going to paste this prompt in. Instead of Adobe, we're going to do it for Microsoft. Microsoft. So spit out these calculations. You're going to give any feedback. Okay, cool. It's going to take a minute to do that anyways. And what you'll see here is that there is no green here whatsoever. So if my formulas are correct, yes, there's 0 here so far. So already, best case scenario would be this is this and this are green. And then we hit 3 and it's like somewhat close to being that valuation. But right now, I'm not liking it. But again, say Microsoft comes down to 400. Okay. Say they're like 350. Like 350 obviously is like a gold mine you're looking at right now. But, you know, they had earnings. The earnings were great. Stock pumped a little bit. Makes sense. But right now, the pump, it didn't really do as much as we were hoping for it to do. All right, here we go. Let's take a look and see. So this is doing 5%. I mean, they're pretty similar actually. But this is 5A12. That's 51013. Very interesting. And again, basing off of the current price of 435. Let's use. I mean, I guess we can use. I think either one. They do different models in this case here. But they're somewhat in the ballpark. This one has the same value, so for this is 33 instead of 35. You could also eyeball and go in the middle of these two if you want to. Again, that's why I always take off 10% because who knows which one of these is going to be right here. Let's do the left one. Why not? So 209. So plug in 209. We'll look at 330. And we're going to look at bull case 589. And what you'll notice, which is interesting also, is that the 1 year 390, this one's 209. Even 5 years, and then where it's valued right now, they're pretty close actually, which is crazy. And again, taking a look here, we've got one green. So bull case scenario, it's undervalued by about 22%, right? And that overvalued. And if you were to use the other values, these are even lower. So is Microsoft overvalued right now? Potentially. Looking at the spreadsheet, of course, it looks like it is. And then the last one we'll do to wrap it up here will be Pinterest, right? So Pinterest was one I did some options. They have earnings coming out this week. So let's take a look at Pinterest. And we'll plug these values in here. So we'll go on to Seeking Alpha. We'll go to Pinterest. Boom, boom. Growth of 17.65. So 0.1765, 17.65%. Low PE ratio is great. What do we got? These aren't looking too bad. So let's plug these numbers in here. So we got Pinterest. We've got on the 1 year overvalued. The share price is 25.27. So if you wanted to technically look at selling cash secure puts, maybe you do the 25 strike price, maybe you do the 24 strike price, whatever the case is. So 25.27, again, about 5% overvalued right now for the 1 year. On the 3 year, we're looking at 34.97. And on the 5 year, we're looking at 48.41. Two greens, 10% for 3 year annualized, not too bad. And then 5 years, 16%. So still not too bad overall. Again, assuming that the growth is going to continue, right? If this company hits the bed and just craps out, then obviously it's going to go bankrupt. Who knows, right? But not too bad. All right. And then we'll do the same thing I prefer this response. Why not? And then we'll do the same thing for Pinterest. And then we'll wrap up this video here. So guys, as you're watching, if you made this far in the video, obviously, thank you so much for watching. Hopefully this gives you a little bit of an insight as to what it is that I'm doing and how you can look at two different models to calculate these things as we go. So it's going to search the web here for Pinterest. Let's see what it comes in with. It's going to take some time. And again, obviously, AI does the math, but it might be a little bit off in terms of what numbers they're pulling from and what numbers they're using. So take that, obviously, with a grain of salt as per usual. I'm waiting for this thing to load it in. Take a couple minutes here. But right now, again, so we're looking at 2 greens so far. So I plugged in those 2 ones. So if we hit 2 out of 3 here, we're looking at a potential undervalued stock of Pinterest. Let's take a look and see as it searches the web here. I have to basically buy time, so play some Jeopardy music, maybe. I don't really know. And again, this is all work in progress still as we're doing more and more of these table calculations here. The hope is to see how these project to the future. Companies that you're looking at that are overvalued versus undervalued in this case here. Obviously just depends on what you're looking at. Again, for example, Palantir is super overvalued according to the discounted cash flow and their PE ratio and everything else. It just obviously depends on what we're looking at here. All right, here we go. Finally, thank you. So again, it does some assumptions, which is the key word here to think about. And again, basing off of 10 years in the future using a discounted cash flow analysis. Bear case, again, revenues are slow. Free cash flow margin is 20%. Base case, same thing. Bull case, same thing. And it puts out the values of bear case 13.76. So we'll go over to here, plug in 13.76. That's worst case scenario. Base case is 26.78. And then the bull case is 49.11. And what you'll see here is that we're looking at only 3 out of the 4. So, maybe earnings brings this value back down, right? What if earnings brings these values down? Who knows, right? Say earnings comes in, puts it down to 20% or down to $20. Green, 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 red. Okay, 5 out of 6. Boom, I hit it. We're good to go. So it updates in real time as these stocks are trading here. So thank you guys so much if you stuck it out through this whole video here. Again, this is breaking down, looking at 2 different model approaches here. Intrinsic value based on earnings per shares and PE ratios and their growth, and also the discounted cash flow. So taking these 2 different approaches, seeing what companies are coming in overvalued versus undervalued, and those companies that are hitting undervalued in both those models here are ones that I'm really starting to like and hopefully it's going to start selling some options on because there's a lot of value there to it in terms of these calculations. So if you made this far in the video, feel free to like the video, subscribe to the channel, turn on the bell notifications, tell all your friends, family, neighbors, pets, you name it. Let's get those subscribers in here. And as per usual, I hope you guys are making money in the market, and I will see you guys in the next video.